Everything we've covered in this course culminates in this chapter. In Chapter 11, we learned how to evaluate a project's cash flows when the cash flows for the projects under construction are given. In truth, estimating the cash flows for a project is the hardest part of capital budgeting, so it's the last topic we'll cover. In this first part of Chapter 12, we'll cover how to estimate a project's cash flows and which cash flows are relevant to our analysis. Part A topics include determining which cash flows are relevant, how to handle depreciation, which is non-cash but relevant due to the impact on taxes and net income, and how to handle salvage values. At a very basic level, we're concerned with a firm's cash flows with the new project minus its cash flows without the project, the incremental cash flows generated by the project. Relevant cash flows. Changes in net working capital are relevant. Typically, at the beginning of any project, there's an investment in inventory or material or spare parts, which is a use of cash, but is partly offset by a spontaneous increase in accounts payable. Interest and dividends are not relevant. The assumption is that all projects are funded by the same mix of debt and equity as the firm, which is reflected in the weighted average cost of capital. To charge a project with interest or dividend expense would be double counting. Sunk costs are not relevant. Any expenses already incurred or committed are not relevant. For example, a pilot study done last year is not relevant to today's decision. Opportunity costs are relevant. Opportunity costs are the cost of an option not taken. These usually involve a physical asset, a plot of land that the firm owns that could be used for this project or sold. It's not free. The project should be charged with the next best thing that could be done with it, what we could receive by selling it. Externalities and cannibalism are relevant. Firms frequently build on a successful product with extensions to the line. The Big Bertha may lead to a bigger Bertha, which may take sales away from the original. This loss of revenue is a cost to the project. Externalities can be positive. Tax effects are relevant. Taxes are paid in cash and must be considered. Though depreciation is a non-cash expense, it affects income, so it impacts taxes, which are cash, so we need to understand how it works. The simplest method is straight line, where the value of an asset minus its salvage value is depreciated over a number of years equally. Firms can, and some do, use this method for reporting to shareholders, but they must use the Modified Accelerated Cost Recovery system for tax reporting. Modified Accelerated Cost Recovery depreciates all assets to zero without any consideration for salvage value. Assets are assigned by the IRS to a class defining the recovery period in years. A half-year convention is applied so that all assets are assumed to be placed in service mid-year the first year. This leads to a 3-year asset being depreciated over 4 years. Under Modified Accelerated, the depreciation basis includes the cost of the asset plus any shipping cost and any installation expenses, the cost to put the asset in service. Based on new tax laws, firms are able to take the expense of an asset off the first year, which we'll see in our example. Since Modified Accelerated depreciates an asset to a zero value, when the asset is sold at the end of a project, there are tax implications. The net salvage cash flow is the cash received for selling the asset minus any taxes paid. You're taxed on the difference between the selling price and the book value. This equation is not in your textbook, but leads to the correct end-of-project net salvage cash flow. If the selling price is greater than book value, then you pay tax on the gain. If the selling price is less than book value, you recover tax on the loss. Let's walk through a sample proposed project and see how all the pieces fit together. First, the given data. Equipment needed will cost $280,000. The cost to ship and install is included. This is where the $280,000 depreciable basis comes from. The new project will require an increase in inventory of $25,000, a use of cash. Accounts payable is expected to increase by $5,000, a source of cash. So the net change in net working capital, 25 minus 5, $20,000. Expected results, new sales of 100,000 units a year at $2 a unit. Variable cost will be 60% of sales revenue. The project will last for 4 years. The equipment will be depreciated based on the new tax law with the expense taken in the first year. The equipment is expected to be worth $25,000 at the end of the project. The tax rate is 25%, cost of capital 10%. Note that the project has a definite, finite life, 4 years. In capital budgeting, regardless if the project is expected to go on forever, it has a life. The assumption is that at the end of the project, all equipment purchased will be sold for salvage. In addition, inventories and accounts receivable will go back to pre-project levels. Thus, the change in net working capital will be recovered. To begin our analysis, we have to calculate the operating cash flows, sales revenue and cost, compute the changes in net working capital, and calculate terminal cash flows, recovery of net working capital and net salvage value. This timeline lays out the general plan: initial cost, operating cash flows, terminal cash flows. We already looked at all the components of the initial cash flows. The net change in net working capital considers the increase in inventory as a use of cash netted against the increase in accounts payable as a source of cash for a net change of $20,000. The initial outlay, $280,000 after tax, is 280 times 1 minus 0.25 equals $210,000. Net change in net working capital, $20,000. So the total outflow at time zero, $230,000. Let's start putting it all in a pro forma statement format. Revenue, 100,000 units times $2 a unit, $200,000 a year. Operating costs, 60% of revenue, for $120,000 a year. There's no depreciation since the firm can deduct the entire expense in year zero. Revenue minus cost equals EBIT. Taxes, 25% of EBIT. Subtract taxes. Add back depreciation. It's a non-cash expense that must be considered for tax reasons, but we're solving for cash flow. It's included here as a reminder of the add-back. Operating cash flows are the bottom line. Let's look at terminal cash flows. We recover all of the investment in net working capital in the final year of a project, so the $20,000 is an inflow in year 4. We were told that the equipment would be worth $25,000 at the end of the project. Since it was depreciated to zero book value, the entire $25,000 is a taxable gain at 25%, $6,250 tax. Net salvage value, $25,000 minus $6,250 is $18,750. Total terminal cash flow, $38,750. This will be added to the operating cash flow. Let's review some of the relevant and irrelevant cash flows we may be presented with. Financing costs are not relevant. They're accounted for in the weighted average cost of capital. Including them as a line item would be double counting. How about a $50,000 improvement made last year? No. This is a sunk cost. It's not relevant to the analysis of the project going forward. What if the facility plan for the project could be leased out for $25,000? This is an opportunity cost, and it is relevant. The project should be charged with the cost of the next best alternative. In this case, it would be the after-tax opportunity cost. What if the new product cannibalizes from the firm's current product line? This would be a cost to the project. Remember, we're concerned with the firm with the project minus the firm without it. Externalities can be complements that have a positive effect, but it's kind of not normal. Putting all the numbers we've come up with together on a timeline, we have the values we will use in the cash flow worksheet to find the NPV. NPV minus $13.34 million. IRR 7.5% versus the cost of capital of 10%. MIRR 8.4%. Payback 3.5 years. With these results, the project's a no-go. This shows the top part of an Excel worksheet to set up and solve our project analysis. This displays all the given data. In the real world, this is how you'd want to set up this type of analysis. Putting all the given data at the top keeps it together, so if anything changes, you can change it in one place. This details the depreciation and after-tax salvage value calculations. And this is the pro forma cash flow portion. Don't forget, a reminder, depreciation is added back even though we didn't have any. Net working capital is recovered. The bottom line recaps the value to be used to find NPV, etc. And finally, our calculations. NPV, IRR, MIRR are all Excel functions, shown to the right of the values. Payback and discounted payback can be found in Excel using logical if statements as shown at the bottom. This shows the whole worksheet with the various sections highlighted. All background data at the top. Note the red line. Everything below the red line, except the depreciation percentages, should be picked up from or calculated from something above the red line. Next comes depreciation, after-tax salvage value, pro forma cash flow, and finally the Excel functions. The Excel example is posted with this lesson for a closer review. A couple of final topics in this section of Chapter 12. First, replacement projects. If this were a replacement project, as in replacing a piece of equipment, the analysis would change. Old equipment is sold, new purchase. Inflows and outflows with tax effects. You'd lose the salvage value of the old equipment, opportunity cost of the replacement. Depreciation would change. Lose the old, gain the new. Incremental cash flows would change. A replacement project is very common, yet more complex than a straightforward new investment. For that reason, we work to understand the general concept of capital budgeting using a new project first, leaving replacement analysis for later lessons. Going back to our project pro forma, what if we expect inflation to increase by 5% every year of the project? This will bias the NPV downward since the cash flows, as originally estimated, do not consider inflation. But the cost of capital is based on nominal rates and does include inflation, so the NPV will be biased downward, not a result we want. So we need to build inflation into our forecasts. To demonstrate further, looking at the basic NPV equation, cash flows in the numerator are real, no inflation, yet the weighted average cost of capital in the denominator is based on nominal rates with inflation included. Nominal rates are bigger than real rates. The result? A downward biased NPV. There are two ways to adjust for inflation in a pro forma analysis. Adjust the discount rate to remove inflation. This sounds like the easiest approach, adjust one variable. But it implicitly assumes that inflation affects all line items the same, and it doesn't. If we had depreciation each year, for example, it wouldn't be affected. The better approach is to make adjustments on a line item basis. Let's make a 5% adjustment to our project cash flows. Revenues and operating costs increase by 5% each year. The result is an inflation-adjusted NPV of a positive $10 million, a huge difference from the negative $13.34 million without the inflation adjustment. Here's the inflation-adjusted pro forma in Excel. This is the second tab in the exhibit posted with Chapter 12, Part A. This ends the first part of Chapter 12. In the second part of Chapter 12, we'll end with risk analysis.